Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, August 18th, about 7:30 Mountain Time. Another beautiful day in the Rockies. Our note this week was titled Inflation Forecast Shortfall. Most of the note focused on inflation this week, but to cut through the chase, when the Fed released their June summary of economic projections, the median inflation forecast for the end of this year was 3%. Right now, the 1-year inflation break even is at 2.64%. And if you take the historic spread between PCED, which is what they were forecasting, and CPI, which is what break evens are based on, the Fed The current market believes that inflation is going to come in about 75 basis points below the Fed's forecast, hence the inflation forecast shortfall. It's just not panning out as they expected. And this month we did have another miss on headline CPI, core marginally above, but it's been some 6 months with them consistently, with inflation consistently undershooting consensus economist forecasts and undershooting the Fed's forecast. So that's hence inflation forecast shortfall. Now, the signs around all this have been very clear. We began with a bit of a discussion of Mark Summerlin, a gentleman we've met over the years, who's a candidate for Fed chair, writing an op-ed in the Wall Street Journal and suggesting that the Fed should reorganize their staff from what he described as an academic think tank. He also gave an interview in Bloomberg where he elaborated on this, to something like a third focused on economic modeling, a third focused on sectoral or having sectoral experts, and another third focusing on markets. The market signals have been very clear on this since Liberation Day, that tariffs were more likely to be a drag on aggregate demand than to create a persistent inflationary force. And we've explained our perspective on it. Fiscal spending is slowing sharply. It's back at its long-term median level. Money supply growth is below its long-term median level. In other words, the conditions don't exist to create inflation the way they did in 21 and 2022. Yield curves are signaling that the economy is slowing and the Fed should be easing. And every time Chair Powell says no economist that he knows doesn't expect inflation to rise, or they all expect inflation to rise, we say, yeah, except the most important one, mother markets. So that's it on that. Bottom line here is, over the last 6 months, looking at the 6-month annualized rate of inflation. Now, that's a little flattered because January inflation has seasonal problems, and it's been pretty elevated the last few years. But nonetheless, CPI has cooled from 3.5 to 1.9 on a 6-month annualized basis. Core from 3.6 to 3.4. The shelter component from 4.1 to 3.1. That's going to continue to go down. Non-housing services from 3.9 to 2.3. And only goods prices have remained stable at 1.1%. below the Fed's target, which, by the way, we think should be 1 to 3%, not 2%. So inflation is going to continue to go down because of comps and because of shelter. We're not worried about the little uptick we had in Supercore, that non-housing services measure in the latest month. It looks quirky, and demand for services have weakened a lot. Also, we've had 2.2s in a row of core goods prices. For something that comprises 19% of the index, this is much ado about nothing. So yes, PPI was a little hot, but we don't think there's pricing power there. That looks very quirky to us and will likely reverse in the coming months. Import prices, which is sort of ground zero for this argument about who's eating the tariffs kind of thing, have been persistently negatively revised. Sort of reminds us of employment reports. And of course, it is the same organization preparing those reports. But ground zero for deflation, China, something we also discussed in the notes because they had very weak activity data that they reported last week. Chinese import prices are falling greater than 2% per annum, and they've been persistently revised down as well. So it does look to us like foreign exporters are eating part of the tariffs at this point and will likely to continue to do so. So bottom line here is there's a couple of ideas in the note worth pursuing. Small caps are breaking out because of small banks. That's telling you they think the Fed is going to ease. We think the Fed is going to ease. We don't expect Powell to signal that, though. We think he'll remain obstinately patient and wait for some more data before clearly signaling that. But the market's convinced that they're going to ease in September. We still think it's reasonably probable that they'll go 50 because we'll get very weak employment data, including the first estimate of the annual benchmark revision in early September. And the Treasury market, we believe and explain in the note, is unlikely to sell off once the Fed begins easing. Last year was all about supply, and one of our best indicators of whether supply is troubling the markets right now, 30-year swap spreads are actually tightening or becoming less negative, indicating the market's not concerned about supply right now. So that's it for me this week. Please consider becoming a full subscriber to Ironside's Macro. It's never different this time. Barry Knapp, have a good week. Thank you.